we could see gold go as high as 3,000, 3,100. I'm not one of those that call for gold to go to $5,000 or $10,000. Eventually, it probably will, but that's 20 or 50 years from now. So that's not my concern right now. But as long as government spends more than it has, and the buying power is decreased in their currency, and gold remains stable, gold only has one way to go. Not straight up or not straight down, but over time, it will have the relatively the same buying power. So I look at gold as the stability, and the currencies as something that just continually are worth less and less. Again, in terms of buying power, not relative strength to other currencies.
Over the past few years, investments in the US dollar have slunk. Many central banks are diversifying away from the US dollar, pound, and euro to pick up smaller currencies like the yuan, yen, and even the Canadian dollar. Gold has managed to maintain its purchasing power, achieving broad-based gains and reaching all-time highs against major currencies like the euro, the British pound, the Canadian dollar, and the Australian dollar. Incrementum's latest research shows that gold prices are up roughly 25% so far this year against a basket of global currencies. Known for his expertise in gold and silver, technical market analyst Gary Wagner combines technical analysis with macroeconomic insights to provide valuable forecasts. While dismissing extreme predictions of $5,000 or more in the short term, he highlights gold's long-term stability as currencies lose buying power due to government overspending. The dollar's purchasing power decreased by 2.53% from 2023 to 2024. In the face of current market trends, Wagner analyzes gold's rally from October 2023, noting its rise from under $2,000 to a record $2,800 before entering an unusual correction phase. Based on his observations, Wagner emphasizes how U.S. political shifts could shape gold prices in 2024. He predicts a Republican administration may heighten volatility while a Democratic transition could be steadier. Gold gained as traders weighed the prospect for a slower pace of interest rate cuts by the U.S. Federal Reserve next year. Bullion was near $2,620 an ounce after closing 0.4% lower on Monday. Investors are digesting the latest data on U.S. consumer confidence, which unexpectedly sank in December on concerns about the economy due to uncertainty linked to the policies of the incoming Trump administration. Now we present the clips of Gary Wagner's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The formula and the patterns that I had been looking at pretty much remained fairly consistent. We've just put up a chart, and what we are basically looking at, and let me take it to what I'm considering the beginning of the rally, which is the first part of October 2023, and you can see gold's trading below 2,000. What I have on the screen is a series of Elliott wave counts, 1 through 5, a correction, and then a second full impulse, or what we call a motive phase, waves 1, 2, 3, 4, 5. And obviously, at the end of October, we hit the all-time record high at 2,800, and we then entered a correction. And this correction is not the basic standard corrections that Elliott wave technicians look to unfold. Typically, we'll see what's called either a compression triangle and a thrust or breakout to the upside, all things being equal, or what we call a standard zigzag, which means we will have a wave down because it's a correction from a bull count, then our B wave up that should go anywhere between 50 and 75% of the move down of A. It came in right at around 68, so filled those parameters. However, if you look at the pointer that I've got, your C wave should actually either go and equal your A wave, which would be these numbers here, right around 2,600, or below, which is called a standard zigzag. And if it's equal to this first down wave, it's basically called a flat. You can see I've labeled it much differently. I've labeled this as a double compression triangle, and that I'm labeling it as a WX, Y, and then XZ. And so the question I need to answer for myself, as well as our viewers, is whether or not this correction is over, because it's played out in a very funny way. And that will have a lot to do with the upcoming administration and the tremendous variance between the current administration, or if the Democratic Party got into the presidential office, that would be more of a consistent flow in terms of the transfer of power to Democrat to Republican. That's going to be a little bit more extreme. So what effects could we see with this next administration? And to me, that's going to be the crux and the most important thing we see when we look at the price of gold next year.
During the interview, Gary Wagner highlights the unique scenario of the dollar and gold moving in tandem, typically occurring during periods of central bank intervention. He reflects on historical instances like 2008 and 2011, explaining how interest rate decisions often trigger simultaneous rises in gold and the dollar. Surprisingly, over the past 5 years, gold and the US dollar have been rising in tandem. Surges in the price of gold this year have been explained by a few macroeconomic factors, including rising global debt levels and the effects of the China-US trade war. Gold prices edged higher in Asian trade on Tuesday, extending their tepid performance as investors remained cautious about the rising dollar following the U.S. Federal Reserve's hawkish tilt. The yellow metal had inched up 0.3% on Monday after losing more than 1% in the previous week, reflecting uncertainty about the metal's outlook. Regarding the dollar's recent strength, Wagner notes an 8% rise against a currency basket in months, driven by market reactions and historical ties to political shifts and fiscal policy. Let's get back to the interview.
The one common thread that I've seen over years in regards to the dollar and gold moving in tandem to the upside has been that they are typically occurs when you have Federal Reserve intervention or global central bank intervention. Specifically with the dollar, it tends to be our Federal Reserve's central bank. And that's because they are really working with interest rates, and that sets a lot of wheels in motion. And you can get tandem moves in gold moving higher, dollar moving higher in times of Federal Reserve intervention. We saw that in 2008. We saw that in 2011. So that's my take on it. Those that effectively were able to call this incredible strength, when you consider that the dollar against the basket of currencies it trades against, not the buying power of the dollar, has risen from below 100 to above 108. That means that the dollar has gained 8% in the time span of a couple of months relative to the other currencies. And that's a really, really strong move in a short period of time. I wasn't bright enough to catch on to what these professionals saw that I didn't, because I was kind of looking at that through blinders, looking at what the Federal Reserve does and how that relates to gold and the dollar. In terms of the election, because it was so close, I wasn't looking what would happen here or there. And the key is we do have historical data about what the next administration might do, because we know what the next administration did a few years back. The Democratic nominee, we had really no data whatsoever on how that might transform or change the workings of the government in terms of fiscal spending, budget deficits, and things along those lines. So I think that what we saw was we had a winner that has been president. And so therefore we had some kind of a historical reference point as to what he might do. And typically what I've heard over and over again, and I happen to believe to a large extent, is if President-elect Trump says he's going to do something, we typically see him do that, follow through with that. And so for that reason, there might have actually been a relief rally that went on. We saw that in U.S. equities. We certainly saw that in the dollar as it gained strength against the euro, the Swiss franc, Japanese yen, sterling. As I said, the basket it trades against. And that's a strong move. If we go back further, we can see it go higher. And let me just adjust this. You can see that it did peak out in 2022. in September at around 114. So it's not at the highest level, but it's above these peaks here, February 2023, this one here, June of this year. And then it seems to have broken out. If you look right around the middle of November, so just prior to the election itself, or just right after, excuse me.
Gold continues to demonstrate consistent growth, driven by robust macroeconomic factors. The upward trend is evident across all time frames. Although short-term fluctuations cannot be ruled out, the precious metal can climb to the long-term target of $3,200 to $3,400 in 2025. Given the intricate interplay between central bank interventions, political shifts, and macroeconomic trends shaping gold and the dollar, how should investors navigate potential opportunities in 2024? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.